Everyone's talking about the Florida housing crash, and okay, fair. Panama City Beach is down almost 6%, Northport and Sarasota are down nearly 9%. Cape Coral is slipping, the headlines are real and the data backs them up, but that's only half the story, and honestly, it's the less useful half. Because right now, while those coastal markets are softening, Tallahassee is up 6.8% year over year. Gainesville is up 5.3%. Ocala just led the entire country in population growth. The whole country. These aren't rounding errors. They're not flukes. They're happening in the same market, at the same time, under the same interest rate environment. So the question isn't whether Florida has problems. It clearly does. The question is why certain towns keep moving forward while everything around them is sliding, and whether you can spot those towns before everyone else figures it out. That's what this video is. 10 Florida towns with something real underneath their prices. Not hype, not speculation. Actual structural reasons why a housing correction doesn't do much damage there. We're talking employment anchors that don't care what Zillow says, insurance costs that make the ownership math work when the coast doesn't, and buyer pools that aren't going anywhere because their jobs and their paid-off mortgages simply won't let them. Some of these towns are affordable, some aren't. But all 10 of them have something the markets that are falling right now simply don't. A floor. And by the end of this video, you'll know exactly what that floor looks like and how to find it yourself. Let's get into it. Here are 10 Florida towns that will survive if the housing market crashes. Miami. Okay, Miami is on this list, and I know what you're thinking. Miami, the city with the eye-watering insurance bills and the HOA fees that cost more than some people's mortgages? That Miami? Yes, but here's the distinction that matters. We're not talking about condos. The condo market in Miami is genuinely struggling. Rising HOA costs, new structural reserve requirements, insurance exposure. That segment has real headwinds. The single-family market is a completely different conversation. In March of 2026, the median sale price for single-family homes in Miami-Dade reached $674,000, up 2.9% from the year before. That appreciation is happening in a statewide environment where prices are declining overall. The reason is geography, and it's brutally simple. Miami-Dade County is bounded on the east by the Atlantic Ocean and on the west by the Everglades, a federally protected wetland. There is no more buildable land for single-family homes. None. When supply physically cannot increase, you don't get the speculative overbuilding that eventually crashes prices elsewhere. Other Florida markets got oversupplied when investor demand spiked. Miami's single-family inventory has nowhere to come from. The other part is who's buying. High net worth buyers from Latin America and Europe, and increasingly domestic buyers relocating from high-tax states, treat Miami single-family real estate as an asset class, not a primary housing purchase. More than 26% of all single-family sales in March 2026 were executed entirely in cash. These buyers don't have a mortgage to worry about when rates move. They're not going to panic sell because inventory ticks up somewhere else in the state. Miami's single-family floor isn't income supported, it's wealth supported. That's a different kind of stability, one that holds regardless of what the broader credit market is doing. Jacksonville. Jacksonville doesn't get the attention Miami does, it doesn't get the retirement press Sarasota gets, it kind of just operates, and that's exactly the point. The median home price in Jacksonville stabilized at $382,000 in mid-2026, up 1.1% year over year. Not dramatic, not flashy, but positive, and that matters when most of the state is going the other direction. The reason Jacksonville holds is that no single industry owns its economy. You've got logistics, financial services, healthcare, and a significant military presence through Naval Air Station Jacksonville, all running simultaneously. When one sector slows, the others don't. That diversification sounds like a boring talking point until you're watching what happens to a market that doesn't have it. Cape Coral built itself around construction and investor flips. When those dried up, there was nothing underneath. Jacksonville has something underneath. Inventory is back to around 5.2 months of supply. That's a balanced market, not a distressed one. And when you look at specific submarkets, the picture gets even clearer. The West Side, which draws working class and entry-level buyers, is sitting at 4.1 months of supply. Tight. Demand there isn't driven by investor speculation, it's driven by people who need an affordable house near their job and have steady paychecks to support the purchase. That kind of demand doesn't evaporate because the news cycle turns negative. Meanwhile, higher-priced coastal enclaves within the metro, like Ponte Vedra, have climbed to nearly 8 months of supply. The correction in Jacksonville isn't absent, it's just contained to the speculative tier. The entry-level market is holding firm, and that's where the real resilience lives. There's also a straightforward demographic argument for Jacksonville that often gets overlooked. It's the largest city by land area in the contiguous United States. That sheer geographic size means the metro can absorb population growth without the supply pressure that forces prices in smaller, constrained markets to overshoot. New residents arrive, builders produce, and the market adjusts without the violent overcorrection you see in coastal corridors where buildable land ran out years ago. Jacksonville isn't glamorous. It doesn't need to be. Orlando. Here's something that doesn't get discussed enough about Orlando. The employment base that runs this city doesn't need housing market conditions to function. It needs ticket sales. About 100 million people visit the Orlando metro annually. Disney and Universal aren't going to close because mortgage rates are elevated. The hospitality and service sector tied to that tourism engine keeps producing paychecks on a schedule that has nothing to do with what's happening to inventory levels or days on market. On top of that, Orlando has been adding technology, defense, and aerospace employment, sectors that bring higher incomes and more stable job tenure than service work alone. The net result is that the metro has been tracking 1.25 inbound residents for everyone who leaves, according to migration data from Move Buddha. Home prices within the city reached $410,000 in early 2026, with a forecast that holds that gain through late in the year. The more interesting number, though, is insurance. Because Orlando sits inland, average annual premiums run between $2,200 and $3,400, a fraction of what coastal homeowners carry. That cost difference is real money in a monthly budget, and it keeps the ownership math workable for a wider range of buyers, even when financing conditions tighten. When a downturn hits, the question is whether there's still a buyer pool. In Orlando, the tourism engine guarantees one. The people staffing those theme parks, hotels, and convention centers live somewhere, and they need those homes to be affordable and accessible to where they work. There's also a specific dynamic in Orlando that benefits buyers in a moderating market. The city's affordability relative to Miami and coastal cities means that buyers priced out of higher-cost metros are still arriving here with realistic purchasing expectations. When coastal markets correct and prices remain elevated in absolute terms, Orlando continues receiving inbound demand from buyers who ran the numbers and found the coast doesn't work for them. That steady inbound flow puts a lower bound on how far prices drift even in a cooling environment. Ocala. Ocala's median home price sits at $269,900. Its cost of living index is 89 out of 100, the most affordable reading of any major market in the state. And in March of 2026, the U.S. Census Bureau identified the Ocala metro as the fastest growing in the entire country, expanding at 3.4% annually. That's roughly 140 new residents arriving every week. This combination of low prices and high inbound migration is what creates a structural price floor. When homes are that affordable and people keep arriving in that volume, there's always another buyer. There's no speculative premium to deflate because prices never ran on speculation to begin with. They ran on affordability demand, people who needed a place to live and could actually cover the payment. Ocala's economy has some unusual durability to it. The equine industry, horse farms, training facilities, breeding operations, generates $4.3 billion in economic activity. Interstate 75 runs straight through Marion County, which made Ocala a major logistics hub long before that became a trendy investment thesis. These are real jobs attached to real incomes that support real housing demand. The insurance number is worth pausing on. Homes in Ocala sit at inland elevations between 70 and 100 feet above sea level, outside virtually all storm surge risk. Annual premiums on a standard dwelling often land somewhere between $900 and $1,820. Compare that to coastal equivalents, which routinely exceed $5,000, and you're looking at a permanent ownership cost advantage that compounds every year. As coastal insurance costs keep climbing, Ocala keeps looking more attractive by comparison. Not because it changed, but because the alternative got worse. Tallahassee. 28,400 state government employees, over 20,000 combined staff at Florida State University and Florida A&M Tallahassee Memorial Healthcare. These institutions were not hired because the housing market was hot. They will not be laid off because it goes cold. That's the entire thesis for Tallahassee, and it's a strong one. The median listing price reached $330,000 in early 2026, up 6.8% year over year. Months of supply for single-family homes sits at 3.6, slightly tighter than the previous year, moving in the opposite direction from most of Florida. The rental market backs it up. Median rents climbed 6.3% to $1,595 per month, driven by steady demand from students, faculty, and state workers who need housing in the capital regardless of what's happening in the broader economy. State capitals don't do boom-bust cycles the way tourist towns and coastal investment corridors do. The employment base here is structurally insulated from real estate sentiment. Nobody at the Department of Revenue or the FSU College of Medicine is watching home price indices to decide whether they still need a place to live in Tallahassee. They live there because the job is there, the job is stable, and it comes with a paycheck that doesn't fluctuate with investor appetite. There's a compounding effect to institutional employment that gets underappreciated. When a large university or state agency anchors a city, it doesn't just provide jobs. It continuously generates a pipeline of graduates, researchers, and professionals who enter the local rental and purchase market year after year. That pipeline creates a natural absorption floor. Even when investor demand disappears and speculative buyers pull back entirely, there are still people who need housing in Tallahassee because they just accepted a position at FSU or a role with a state agency. That rhythm doesn't stop. Inland North Florida also keeps insurance costs predictable. Annual premiums average between $2,100 and $2,400, well below the coastal distortion zone. Gainesville. 61% of housing in Gainesville is renter-occupied. That's not a quirk. It's a structural feature of a university town, and it fundamentally changes how market corrections move through the local economy. The University of Florida doesn't graduate the student body and close, it cycles. New students arrive every fall, faculty appointments renew. UF HealthShands continuously expands its staff. The demand for housing in Gainesville is perpetual in a way that has nothing to do with investor sentiment or mortgage rate headlines. It's driven by enrollment calendars and residency program schedules set years in advance. The median sold price hit $326,500 in mid-2026, up 5.3% year over year. Properties went under contract in a median of 26 days. For investors, cap rates on rental properties average between 6.6 and 8.3%, numbers that are difficult to find in coastal markets at comparable price points. Insurance in Gainesville runs between $1,940 and $2,800 annually for a standard policy, well below the statewide average. That keeps total ownership costs manageable for the landlords who serve that large renter population. When a housing correction hits, what actually gets hurt is speculative buyer demand, people who bought hoping to flip or refinance at a gain. Gainesville doesn't run on that. It runs on enrollment cycles, research grants, and healthcare hiring. A downturn in housing sentiment doesn't change when fall semester starts. Pensacola. The median home price in Pensacola stabilized at $315,000 in 2026. Average monthly rents near Naval Air Station Pensacola run between $1,300 and $1,460. Those numbers look reasonable, but the mechanism behind them is what makes this market genuinely interesting. Basic allowance for housing. the monthly stipend the military pays active duty personnel to cover rent or mortgage costs, increased 5.4% for personnel stationed in the Escambia and Santa Rosa County corridor in 2026. An E5 with dependents now receives $18.63 per month. An O3 with dependents gets $22.71. These aren't private sector wages that track the business cycle. They're federal disbursements set annually by the Department of Defense, and they flow directly into Pensacola's housing demand whether the broader economy is expanding or contracting. The VA loan factor compounds this. Active duty and veteran buyers using VA financing require zero down payment and carry no private mortgage insurance requirement. When credit conditions tighten and conventional buyers pull back, VA buyers stay active, because the financing structure is set by federal policy, not market rates. NAS Pensacola, Corey Station, and NAS Whitingfield together produce a base of housing demand that runs on military orders, not market cycles. Single-family properties in South Pensacola and Warrington run between $200,000 and $320,000, well within reach for VA buyers at virtually any rate environment. The Pentagon doesn't change its basing decisions because inventory rose somewhere else in the state. Sebring. This one requires a slight shift in how you usually think about housing market risk. Most corrections are credit events. Prices fall, equity evaporates, over-leveraged buyers can't service their debt, foreclosures flood the market, prices fall further. That's the cycle. It's self-reinforcing, and it's what turned some Florida markets in 2008 from expensive to devastated. But the cycle requires mortgage debt to operate. Remove the debt and you've removed the mechanism. Sebring in Highlands County carries a home ownership rate of 87.5%, and a large share of those owners hold their properties outright. The average home value in Highlands County sits around $235,720. This isn't a market where people stretch to buy at the peak hoping prices would keep climbing. It's a market where retirees sold higher-priced assets elsewhere, arrived with cash or near-cash positions, and planted themselves permanently. You cannot foreclose on a house with no mortgage. That's not a metaphor. It's a mechanical limit on how far prices can fall in a credit contraction. When the foreclosure wave that wiped out over-leveraged markets arrives, Sebring has almost nothing to contribute to it. Insurance here averages between $16.20 and $18.20 annually. The inland location in Highlands County keeps storm exposure low, which keeps the risk profile manageable, which keeps the premiums down. And as coastal retirement costs keep escalating, flood insurance mandates, rising HOA reserve requirements, wind mitigation retrofits, Sebring's combination of low prices and low carrying costs becomes harder to dismiss. The equity growth opportunity isn't speculative. It's the result of a permanent cost divergence between coastal and inland Florida that widens every year insurance rates reset. Lake Nona. The broader Orlando market has normalized. Inventory is up, days on market have stretched, and buyers have leverage they didn't have 2 years ago. Within that softening environment, Lake Nona is doing something different. Lake Nona's median listing price sits at $803,500 with closed sales averaging $662,500. That's a premium product sustaining itself in a moderating market, and it's holding because of what physically surrounds it. The Medical City campus, a $2 billion development, includes the Orlando VA Medical Center, Nemours Children's Hospital, UCF Lake Nona Hospital, and an incoming 60-acre Advent Health Wellness campus. KPMG and Siemens Energy both operate corporate campuses in the same corridor. These are high-income professionals whose employment is tied to healthcare delivery, medical research, and corporate operations, not tourism fluctuation or investor appetite. Median monthly rents in Lake Nona have reached $3,200. That figure isn't arbitrary. It reflects what the local employment base can actually support. These are workers earning enough to pay $3,200 monthly in rent, which means they're also buyers who can support home prices in the $600,000 range. The inescapable fact about healthcare employment is that it cannot be done remotely. You cannot perform a surgery from a beach house. You cannot staff a children's hospital over video call. The workers at Medical City have to live near Medical City, and that requirement maintains a resident buyer pool that is largely immune to the sentiment shifts that drive speculative markets up and then back down again. When the broader Orlando market softens and investors pull back, Lake Nona still has thousands of medical professionals and corporate employees who need housing near their employer. That's a floor that doesn't move. Inverness. Inverness sits in Citrus County in north central Florida, roughly an hour and a half from Tampa. It is not a market that makes headlines. The average home value in Citrus County runs around $278,317. Properties there don't get written up in real estate investment blogs, and that absence of attention is precisely what makes it worth understanding. Between 66 and 71% of all townhouse and condominium transactions in Citrus County in 2026 were completed entirely in cash. That figure is not a typo. It means the majority of buyers in this market arrived without a lender, without a rate lock, and without any of the credit exposure that makes other markets vulnerable when conditions tighten. These are retirees who sold primary residences elsewhere, often in higher-cost coastal counties or northern states, and deployed those proceeds directly into Citrus County properties. The insurance picture reinforces the case. Citrus County's inland position keeps annual premiums in the $1,600 to $1,800 range, among the lowest available in the state. Combined with a purchase price under $300,000 and no mortgage payment, the monthly cost of owning a home in Inverness can be genuinely modest. That full cost of ownership calculus is what draws the demographic that keeps this market stable. There is a longer-term dynamic developing in Inverness and the broader Citrus County corridor that isn't fully priced in yet. As coastal retirement communities in southwest Florida absorb escalating insurance and HOA costs, the relative appeal of affordable inland alternatives strengthens. The buyers who moved to Cape Coral or Northport a decade ago are watching their carrying costs rise significantly. Some of them will relocate. The inland markets they'll evaluate include Inverness. And the prices here still reflect a market that most people haven't gotten around to discovering. A cash buyer in a low-insurance, low-tax inland county with affordable home prices doesn't foreclose, doesn't panic sell, doesn't disappear when sentiment turns. They just live there and keep the floor exactly where it is. What also separates Inverness from many markets in this video is how early in its growth cycle it still appears to be. Markets like Lake Nona and Orlando have already absorbed significant attention and capital. Their resilience is established and largely priced in. Inverness is still operating below the radar of most retirement relocation conversations. That creates a window. Not a guaranteed one, not a speculative one, but a real window where the structural advantages of the market haven't yet fully translated into price appreciation. The fundamentals are there, the recognition isn't. That gap rarely lasts indefinitely. The statewide Florida picture in 2026 is a buyer's market. Inventory has climbed to 7.47 months of supply. The median close price has slipped year over year. Properties are sitting on the market an average of 84 days before they transact, up from 68 days the year before. That data is real and it matters, but treating the state as a single market is how you end up drawing the wrong conclusions. The 10 towns in this video aren't outperforming because of luck or timing. They're outperforming because they have inputs that don't respond to housing sentiment, military paychecks, university enrollment cycles, logistics contracts, healthcare employment, and retiree cash buyers who settled their mortgages long before rates started climbing. There's also a policy development arriving that will specifically benefit the affordable inland markets on this list. Florida's proposed constitutional amendment, heading to voters in November 2026, would raise the homestead exemption to $250,000 by 2028. That change effectively eliminates a large portion of the non-school property tax bill for primary homeowners. The markets that benefit most are the affordable ones: Ocala, Gainesville, Sebring, Inverness, where a $250,000 exemption covers a meaningful fraction of the home's total assessed value. For a retiree already carrying a low insurance bill and no mortgage, that additional tax reduction makes the ownership cost picture look even better. The markets that are sliding right now built their prices on demand that was always going to leave. Investor flips, short-term rental income projections, migration patterns that required remote work flexibility and low rates to sustain. When any of those inputs changed, the price had nowhere to stand. The towns in this video built prices on demand that stays, paychecks tied to military installations that aren't closing, tuition cycles that repeat every August, distribution contracts that run on 10-year terms, retirees with no debt and no reason to sell. That's not a lucky combination, it's a pattern. And it's one you can use to evaluate any market, in Florida or anywhere else, before you put money into it. The 3 questions worth asking about any market you're considering. What keeps buyers here when sentiment turns negative? What does it actually cost to own? Not just the mortgage, but insurance and taxes. And how much of the buyer pool is carrying debt that could become a problem? The 10 towns in this video answer all 3 questions well. Most Florida markets don't come close.